This is the Daily Market Comment by Marios Hadjikyriacos. I'm Maria Bashirdes. Thanks for joining us at xm.com. It was a relatively quiet trading session in the FX complex on Monday. Investors appeared reluctant to make any big moves with geopolitical tensions simmering, preferring to bide their time until the dust around Russia's coup attempt settles. Defensive assets such as gold and bonds attracted some safe haven flows early on, alongside currencies like the Japanese yen and the Swiss franc. However, these moves were relatively small and ultimately retraced as the session progressed once it became clearer that the situation in Russia was stable. The yen has resumed its downtrend and is currently trying to breach its multi-year lows against the euro and pound as the capital exodus from Japan continues unabated. Traders are probably correct that the chances of direct FX intervention are low, something reflected in subdued implied volatility measures for the yen. Yet the prospect of a Bank of Japan move next month has become increasingly realistic as core inflation has fired up, and markets seem to be sleeping on this risk, judging by the slow grind lower in Japanese yields. In this sense, the inflation stats from Tokyo on Friday will be crucial for yen crosses. Meanwhile, the dollar is trading a touch lower on Tuesday without any clear catalyst behind the retreat. The dollar's lackluster performance over the past month is rather striking, considering that this was a period when markets recalibrated the Fed's rate path higher, scaling back bets of any rate cuts this year. It is even stranger that the euro has been so strong in June, despite incoming signs that the Eurozone economy is losing steam at an uncomfortable pace. The ECB raising interest rates and telegraphing more to come certainly helped boost the single currency, but ultimately capital doesn't flow into struggling economies. The Nasdaq fell sharply yesterday to close 1.2% lower as some air came out of the tech rally. However, this retreat might be linked to quarter-end rebalancing flows and some profit-taking after such a monster bull run, rather than any massive reassessment about the future of tech giants. For now, investors are happy to turn a blind eye to expensive valuations and stagnant earnings growth, although this mindset could change in a hurry if liquidity begins to dry up later this year. Meanwhile, in Canada, the loonie hit its highest levels in nearly 10 months today, and the upcoming inflation report will decide whether this rally still has some miles left in the tank. This was today's Daily Market Comment. Thanks for joining us at xm.com.